like to introduce to you Warwick and Martin to continue. Thank you.
Thank you, Roger. That was fascinating. And good afternoon, everyone. My name is Martin Huang, a partner in audit insurance. Joining me in this segment, it's Warwick Spargo, my fellow partner in audit. We will be providing insight on preparing for a smooth VAGO audit. I'll be sharing with highlights to some current accounting issues that's common in the public sector. Next slide, please, Aaron. While the accounting standards are no different, I guess, between sectors, there are unique circumstances in the public sector that can render the arrangement in substance quite different to what it appears in form. The case study here I want to go through, it's about lease assessment from a lessor's perspective. While WSP 16 effectively removed the distinction between finance lease and operating lease for lessees, it remains relevant from a lessor's perspective. The key assessment between the two is whether the lease transfer substantially or the risk and rewards of the underlying assets from the lessor to the lessee. When we assess a recent arrangement, we noted the lessor retains the legal ownerships of the assets, the lease term was only a quarter of the useful life, and the lessor is also responsible for maintenance and obsolescence of the assets. So these factors do not appear to suggest transferring substantially all the risk and rewards and pointing towards an operating lease arrangement. However, when we dive deeper into the arrangement, we noted the lease is really governed by legislations. In fact, the legislations gives the lessee legislative exclusivities and economic controls of the underlying assets. It's a substantive use and with continuity. And the lessee also takes on the operational responsibilities and the risks associated with it. So therefore, in substance, we have actually landed this as a finance lease arrangement. We noted the recognition and presentation between operating lease and finance lease are quite different too. It is more straightforward under the operating lease arrangement, where the assets will continue to be recognized as the relevant PP&E and the lease payments as income. However, more work is required for finance lease. The underlying assets will be removed from their book and replaced with finance lease receivable, commonly calculated using a discounted cash flow model. And the revenue is the interest income from unwinding the finance lease receivable. Just the point I guess want to highlight is really the substance and forms sort of difference in the public sector sense. Next slide, please, Aaron. So it's the second topic, and I want to discuss today is the application of FRD 103 and the recent amendments to WSP 13. Now, in the public sector, the transport and local government sectors are the first to be impacted by these amendments, as they are required by the FRD 103 to conduct full revaluations this year. We have already observed inconsistencies and a lot of implementation challenges in the sectors, and they have indeed resulted in material movements to the PP&E balances and material fair value adjustments to those assets. So one key aspect of this amendment, it added guidance on the application of the cost approach to fair value. Now, given the uniqueness of most public sector assets, cost or replacement cost is often the most commonly used approach to their fair value of these assets. So I want to bring to your attention two of the additional factors out of the many the valuer may need to consider. The first one is site preparation costs. When considering a cost, maybe a building, and with a couple assumptions need to apply. One, we need to take into account the market participants will act in its economic interest. The second, the market participant does not possess the subject assets. Now, the site preparation costs must be included in the cost if they are not already reflected in the fair value of the land. This includes costs required to prepare the land or costs required to remove and dispose of any unwanted existing infrastructures. However, we know demolition costs, the compulsory acquisition costs are to be excluded from the valuation. The second factor on the list there I want to highlight is the disruption costs. So when considering this factor, we are required to step into the shoes of the market participant and what they are obliged to do to minimize the disruptions to services and what are unavoidable. For example, if you are to consider, you will need to consider bus replacement costs or traffic management costs if you are performing work on train tracks or work on roads. So as you can see, these considerations can be quite substantive and are very subjective. So my recommendation in these instances would to start engaging the stakeholders early, and that includes a conversation with your auditors. With this, I'll hand over to Warwick for his tips for a smooth audit.
Thanks, Martin. I want to provide some tips for a smooth VAGO audit. A lot of these things are really common sense, and a lot of you are probably doing it anyway. But I suppose my view is the external audit shouldn't be and doesn't need to be adversarial. We are all looking to get to the same destination, and my view is we should be getting there at the same time without many speed humps. So the first thing I would say is engage VAGO early, particularly the director, because the director is the one who probably has the ultimate say in each portfolio about treatments and any accounting issues and disclosures that are required. So if you can, get in and talk to the director as early as possible. If you're involved in an industry like local government or water or something like that, ensure that the director does come to those meetings regularly to provide a snapshot on the issues across the sector, because the director will be the one who has the visibility on the current issues and views on various issues of accounting issues and in developments within the sector. One of the things we do is particularly, and I think most organisations will do it, but I will emphasise, particularly where there is nowadays remote audits, ensure that there is weekly meetings with the audit team throughout the audit, every week, at least one, maybe two, just to get an update of where the audit's at, how it's progressing, any speed humps and that, so we can get there at the right time. The other thing is to seek opinions on potentially contentious issues from VAGO early, and that would be pre-year end if you can. Anything that arises, any major material transactions, please, I would say, engage them early, particularly the director, about views on those. But what I will say is make sure that you, as the client, have a position to put to VAGO, because I think VAGO does not want to necessarily be the one who does the research and provide you the advice on what you should be doing. I think it's important that you have a research position that you can put to VAGO, how you believe the treatment should be, and they can respond to that. The other thing is make sure you are talking through your relevant portfolio department, that you are getting the developments across the portfolio, because a lot of the new treatments and issues that come through government and the templates from DTF come through the department. So ensure you are also connected there to make sure you are getting those as well. Again, have a pre-year end meeting with VAGO to discuss any issues, any major material transactions that are coming through, in order that the audit can be continued or finished in a smooth way. The other area is skeletal accounts. I know normally there's issues with that, where there are plans and trying to get them out early with the DTF, changes to the DTF template. But I will emphasise that using this, and now where there is tier 2 reporting to your advantage, making changes to your accounts early, any disclosures you need, engaging with the auditors early to get them locked into the format of your accounts, so that it minimises disclosure and finicky changes around formatting and that at the end. The other thing that you should be doing is reviewing your notes for materiality, trying to streamline as much as possible your accounts, so that you are basing it on materiality, and that will be your materiality and the importance of yourself and your board you place on each of the disclosures. So making sure you can declutter that there isn't notes that are not needed there early. Making sure that these skeletal accounts do go through the audit committee so they have full understanding of the accounts or the format of the accounts, and they can have discussions about the level of appetite for streamlining as well. The next one is the audit committee date, and I think in setting the audit committee date for the finalisation, having good discussions with the auditors about what's practical about providing clearance at the audit committee, because the last thing you want is to be having a second audit committee, or the closing report doesn't make it, or there's not enough time for proper discussion or research by the members. So have a good chat with the audit committee based on your experience on when it's practical to get to when the audit date should be, that clearance can be made. And then secondly, making sure your timing of your board meeting is practical as well, so that VAGO can provide clearance and that you don't have to re-sign your accounts, because there's nothing worse than having a board meeting and passing the motion to sign the accounts, and then they're signed and then having to go back and redo it again. That just creates a long more time than you need. So making sure there's an agreement on the audit dates as well. The next one is making sure the whole business, not just the finance team and the CFO and the auditors, are involved in the audit process. And one of the things I see that's a good way of doing this is providing a reconciliation to the board and the audit committee and the senior management team between the management accounts, the latest management accounts at 30th of June, and the statutory accounts. So it gives a good understanding about where accounting nuances do impact the financial statements, and also an understanding of what the statutory accounts actually mean compared to what you've been discussing as the management team results. So it does hopefully circumvent any surprises that come out in relation to those as well. The other thing that I see as a good is a page turn outside the formal audit committee with the audit committee members, and opportunity for the board to go through the accounts, where they can ask the so-called understanding questions and not feel embarrassed about asking basic questions, and that also gives them a good understanding and ownership of the accounts at the end. And the last one is ownership of the results, and this goes on from the previous one about the page turn and everything else, but it's also making sure that the board, the audit committee, and the whole senior management team does own the accounts and the result. And it'll be things like also having a comprehensive analysis of your going concern and sustainability, and that there is a proper cash flow analysis. And I know in the public sector, going concern is probably not the major issue because the government does basically underwrite everything, but the sustainability of the business, particularly in the current environment, is very important, and I know auditors do ask for that. So that's probably all the tips I have, but I know a lot of you will be going through an audit at the moment. I hope it's been relatively smooth, probably at the end of the audit, but I wish you all the best. And